I'm Anthony Smith with HFG Trust, and you're watching the Chart of the Week 2-minute video. This week's chart shows a nearly 32-year historical chart of the price to book value ratio on the S&P 500. There's nothing magical about 32 years. It just happens to be as far back as we could go with the Bloomberg terminal. Now, most of you who have visited with us at HFG Trust will recognize the price to book value ratio as one of our preferred stock valuation metrics. Stock valuation metrics are a little bit like family and friends. They have flaws, limitations, but we do rely on them. And we do prefer the price to book ratio over another widely used ratio, which is price to earnings, or the PE ratio, because the denominator in that ratio, earnings, is more prone to manipulation than is book value. So backing up, book value is the equity on the balance sheet. It's assets less liabilities. What's left over is the book value of equity, and it can be divvied up on a per share basis to facilitate the calculation of the price to book ratio. Companies trade at multiples to book value, typically depending on investors' expectations for earnings growth of those businesses. So we know that the S&P 500 hit yet another all-time high this week. That index of large cap U.S. stocks is trading at an average price to book ratio of 4.6 times currently. Of course, the absolute ratio in isolation doesn't tell us quite what we want to know. I'm sure you'd like to know how it compares to itself over time. So let's look more closely at this chart. 4.6 times is it's high, but it's not the highest it's been in history. It briefly kissed 5.2 times in March of 2000, but it's certainly at the higher end of its historical range. And I think it's safe to say we're closer to peak valuations than we are to trough valuations, which shouldn't come as a surprise to anyone. Mathematically, stocks can go higher while that price to book ratio remains unchanged, as long as earnings continue to grow the equity, the denominator. But maybe just don't bank on multiple expansion being the primary driver of stock returns in the near term. That's it for now. Thank you for watching. We'll see you next week.